Welcome back to the Floor of the CME Group here in Chicago, February 14th, Valentine's Day. I'm Killer from Treasury Curve. Treasury Curve is an institutional money market portal. We assist firms in their overnight cash management. And Obama, he gave a nice little Valentine's Day present to everyone. He unveiled his 2012 budget deficit of a mere $3.73 trillion. Folks, I'm not here to talk politics. I'm here to discuss trades and how do we trade that. This will be the fourth year in a row, four, of the budget deficit being north of $1 trillion. And I think that leads us back into our conversation we've been having about the 100-year bond. The 100-year bond. Amazing. But I think this really opens up the window here. And we've talked about this. As a curve trader, there's all different types of acronyms out there. There's the FOB, which stands for the FOB. It's the 5-year over the bonds. There's the FIGHT, the 5-year over the 10s. There's the NOB, the NOB. We have the BOB now, which is the ultra over the bonds. And we've been talking about there's a lot of rumors out there. Comment here, on this video or get me on my Twitter @TheKiller. But what do you think the next acronym is for this 100-year bond? I'm hearing a lot of rumors. They're just going to call it the prayer. So we'll see. Let's drill down a little bit here into these treasuries. That 117.23 unemployment low. I tweeted that. There was a great pivot there. We've rocked since then, come up to 119, even rejected it earlier this morning and come back, and we're testing the highs currently. That weekly pivot is coming at 118.01. That overnight low of 118.03 is a nice play, so I hope you're on board for that. The 10-year, the weekly pivot is coming at 118.11.5. Be mindful of that today. Clearly there's a huge move in rates. We've seen this really move too fast, too quickly, but it's all contingent upon the stock market. As the S&P and the NASDAQ, as they did today, made new contract highs, the bond market's going to look to that. Clearly inflation is the situation at hand, and people are talking about exiting, but I think a lot is up in the air in this bond market. S&P, surprise, surprise, folks, another new high, 1330.50. I think under 1319 in the S&P, the bulls are a little bit nervous, but the bulls are not nervous at all right now. And I think that 1336, that's an important level. That's a trend line we've been looking at. Violation of that, we could really rock up and see some stops. But if we stay underneath that, they have a chance of getting under that level. The euro currency, check out that 100-day. I spoke to that 100-day many a times. We looked for that and we got it. So underneath here, that 50-day is coming at 133.59. The 200-day is down at 131.03. We're looking for a lot of resolution still in the sovereign debt. Those shoes have not dropped yet, folks. The Middle East, Mubarak, he left the house, left the castle. We saw that, but there's a lot of other moving parts, so we'll see. And I ended last week with a nice little segment. Well, today we have a special treat for you as well. It's Valentine's Day, folks. So a good friend of mine, the man, the myth, the legend, Peter Yastro. Peter?
The question today is the economy getting better? We've seen the data start to get better. We've seen the stocks rally huge, and now we even have people talking about pressure on interest rates. That would mean that the economy is getting better. Or is it? What we've really seen is that as the economy got terrible, and now the Fed has stepped in and created an enormous deficit of over $1 trillion. $1 trillion over our economy would be about 3 to 3.5% growth a year. That's all we got. We got no multiplier, we got no stimulus. Also, if I talk to people in the real estate market, they continue to see all the deals getting done below the mortgage price. These are called short sales. And that's what's happening in the real estate market. People are finally biting the bullet and getting out of these properties that they paid too much for a few years ago. The mess is out there and it's enormous. And Bernanke knows it's enormous. And he's only got one tool. He's got to keep rates low. Short-term rates will stay really low. And for those of us who've paid our debts and paid our mortgages, let's make sure we don't miss this. We're going to inflate the economy to get out of the problem. Stick with some commodities, stick with some gold, and stick with your stocks until you're told otherwise, because Uncle Ben has no choice but to keep the rates at zero or actually below zero until we work our way out of the problem. And the problem's huge. Too many people in this country don't understand finance, and they don't understand borrowing, and they don't understand debt, and they think they're supposed to borrow huge sums of money to buy these houses because they think they're cheap. And the odds of someone keeping their job now for 30 years and paying off that mortgage is only getting worse. I'm afraid that we're going to see a long period of low interest rates from the Fed, but we know that now. They're telling us it clearly, so let's take advantage of it. Thank you.
When you call my name.